All right, let's talk about financial planning. You can think of it as a compass for your business, something that helps you navigate what's coming up ahead. So let's get right into it.
So let me start with a question that might sound, well, kind of crazy. Imagine a company, and it's doing great. It's profitable. Sales are up. Customers are happy. Now, could that successful company actually go bankrupt?
And the answer, believe it or not, is a huge yes. A profitable business can absolutely go under. And it almost always happens for one deceptively simple reason: it just runs out of cash. See, it doesn't matter how much money people owe you if you can't pay your own bills right now.
And that is exactly where financial planning comes in. It's the tool set that lets a business see around the corner, predict those cash shortages, and steer clear of them long before they turn into a full-blown disaster.
So what is it really? Well, think of financial planning as drawing a detailed financial map for your company's future. It uses budgets and forecasts to figure out exactly how much cash you're going to need and when you're going to need it. It's all about making sure you can always keep the lights on and have the money to grow.
Now, pretty much everything in financial planning comes back to one single starting point: the sales forecast. If you can get a decent handle on what your future sales will look like, you've got a solid foundation for your entire plan. But if that forecast is way off, the whole thing can fall apart pretty quickly.
So how do you take that sales number and turn it into a real financial plan? Well, one of the most popular ways to start is something called the percent of sales method. It's a really logical, straightforward way to approach it.
The big idea here is actually pretty simple. It assumes that if your sales go up by, say, 20%, then other things will go up by about 20% too. Things like the inventory you need to have on hand or the amount your customers owe you. It basically connects your sales directly to how much cash you'll need to run the business. And the process itself is pretty simple. First, you figure out which parts of your business are tied directly to sales. Then, you figure out what percentage of sales they represent right now. After that, you just apply that same percentage to your new sales forecast. The last step is to see if all that growth means you'll need to go out and get some extra funding.
Let's look at a quick example. This company thinks sales are going to grow by 50 billion won. Now that growth means they'll need about 24.4 billion in new assets, more stuff in the warehouse. So where's that money coming from? Well, growth itself creates 9.4 billion from suppliers, and they're going to reinvest 21.6 billion of their own profits. When you do the math, they don't need any outside money. In fact, they have a surplus of 6.6 billion.
And this is so important to remember. Financial planning isn't just about spotting problems. Sometimes it shows you amazing opportunities. Finding a surplus like this is a huge win. It means the company has extra cash to maybe pay off debt, start a new project, or give back to shareholders, all because they took the time to plan ahead.
So, the percent of sales method is awesome because it's simple and quick, but it is built on a pretty big assumption. For a more precise, data-driven picture, we can turn to a different tool: regression analysis. This method doesn't just assume there's a connection between sales and funding, it uses your past data to prove it.
Okay, let's level up now and look at a more sophisticated tool: regression analysis. This is what you use when you want to get really precise and use the patterns hidden in your own company's history to map out the future.
Honestly, regression analysis is kind of like being a financial detective. It sifts through all the clues in your past data to find the true mathematical relationship between things, like your sales and the cash you needed. And then it turns that relationship into a simple formula you can use to predict what's next.
To make this work, you need historical data. By plotting your past sales against the actual funds you needed in those years, a pattern starts to emerge. You are literally looking backward to get a much clearer view of what's coming forward.
So after the analysis crunches all that historical data, you get a predictive formula that looks something like this. Now, don't let the numbers scare you. Think of it like a simple recipe. All you have to do is plug in your future sales forecast, and it does all the heavy lifting for you.
So you take that formula, and you plug in next to your sales target, in this case, 475 billion won. And boom, the result is a super precise prediction. The company is going to need 379.8 billion won to fuel that growth. That's the real magic of data-driven forecasting.
Okay, so planning for next year is crucial. But let's be honest, businesses live or die based on what happens this week and next month. And for that, you need the most critical short-term tool there is: the cash budget. The idea here is simple, but it is absolutely everything. You track every single dollar coming in the door and every single dollar going out.
The whole point is just to make sure you never drop below a safe amount of cash in the bank. This is how you avoid that deadly cash crunch we talked about at the beginning.
Just look at this little story of 2 months. In January, the company knows that more cash is going out than coming in, so the plan says they need to borrow $70 million just to stay safe. But then look at March. They're forecasting a huge cash inflow, which means they can easily pay back that loan and end up with a big pile of cash.
So by managing its cash flow this carefully, the company doesn't just survive those tough months, it thrives. It plans for the dips, and after 6 months, it ends up with a massive cash surplus of almost 2.5 billion won. That is what effective planning looks like.
So, you've done your long-term forecasting, you've nailed down your short-term cash budget, now it's time for the grand finale. This is where you put it all together and create what are called pro forma financial statements. Pro forma sounds fancy, right? All it really means is projected. These statements are the final product of all your hard work, giving you a clear, numbers-based preview of where your company's headed if you stick to the plan.
I mean, just look at the difference here. Without planning, your future is just a bunch of question marks. But with a solid plan, you replace all that uncertainty with actual numbers. You have a target for your sales, a projection for your profit, and a clear idea of how much cash you'll have in the bank. You've created a clear path forward.
So I'll just leave you with this final question to chew on. Is your organization, or hey, even you in your personal life, actively predicting and shaping your financial future? Or are you just reacting to whatever happens to come your way? Because as we've seen, the difference between those two things is everything.